Hi folks, Mark here from Maple Capital Partners. In today's video, we're going to dive into a recent study from Harvard where they looked at the state of the housing market in 2022 and made some projections about where they think housing will go in 2023. So let's take a dive into the data that they were looking at. So in 2022, obviously it's no surprise that housing appreciated. In most metros, it was up double digits. In fact, across the nation, it was up around 20% for the Case and Shiller housing index of the top 20 markets. Of the top 100 housing markets, a full 67 of those experienced record high appreciation in last year. So not only did prices go up for housing, but also rents. They were up about 12% nationally, so a little bit more modest than price appreciation, but still a very high number looking back historically. In some areas, in fact, that was as high as 20%. Areas where rents were up the most also tended to be the areas where housing prices have appreciated the most. And those were a lot of the markets that we pay attention to and that you hear constantly in the top 10 lists that come out. So those were areas like the South and the West. Now, looking at rentals specifically, rents for single-family rentals grew faster than for apartments, and that was spurred by demand for more living space and the push to work from home during the COVID pandemic. Single-family rentals have steadily become more and more dominated by investor purchasers, and last year was no exception. Last year, a full 28% of all single-family homes were sold to investors. A year prior, that number was 19%. During the 2017 to 2019 era, that was around 16%. So it's clear that investors are starting to take a larger share of these single-family rentals as investment properties. But why are rents and prices continuing to increase? In short, the answer is supply and demand. So on the supply side, existing home inventory last year bottomed at around 850,000 housing units. That was a record low. Now, not only that, but vacancy rates also were near a record low at around 5%. The recent run-up in prices, low housing inventory, and record low vacancy rates are really a result of the prior decade, a decade that was one characterized by underbuilding. There was just not enough supply being created for the amount of demand and household formation that was coming about in the economy. Now, spoiler alert, what drives demand? It is household formation. And so on the next slide, we're going to take a look at what that looked like. So you can see that over the last decade or so, really household formation has picked up quite strong. And the number of households grew at an annual rate of around 1.6 million per year in the 2020 to 2022 range. Now, millennials were the driving factor behind that. Many of them have lived at home during the pandemic and are starting to get out of the house and, start to get into prime home buying age, which is your early 30s. Now, this growth was fueled by low rates, income gains, and low unemployment rate over those years, as well as a healthy dose of federal stimulus. The share of millennial households, however, is still low compared to previous generations. And that suggests that there's still room to grow in terms of household formation, and thus prices have maybe some room to appreciate. The Harvard study also talked about the disparity in the level of home ownership amongst white and minority groups. However, on the bright side, those groups are increasing their home ownership rates, and that gap is narrowing ever since 2016. And that did speed up in the last 2 years. The punchline to all of this, though, is that the last 10 years of unfettered bull markets in real estate really came to an end in 2022. And that brings us to the Fed. Higher interest rates. That's, if 2022 was characterized by anything, it would be that statement. So you can see from this graph the fact that interest rates went up. It also had a huge impact on the monthly mortgage payment of the median home in the United States. In fact, between December 2021 and April 2022, rates backed up 200 basis points. The 30-year fixed rate is up even more by now, although it has been receding in recent weeks. Still, the rate today is about double where it stood a little bit over a year ago. And this jump in rates obviously had an impact on monthly mortgage payments. Those payments went up the equivalent of if prices had appreciated 27%. That's not counting actual home price increases over that same time span. So that had an adverse impact, obviously, on Americans' ability to afford a home. At today's prices, the down payment of a first-time home buyer on the median home would be $27,400. That rules out a full 92% of renters whose median savings are just $1,500. So you can see the run-up in both prices and interest rates last year had a really big impact on the average American's ability to buy a home, and unfortunately has kept many people renting that would be home buyers. What we have is an affordability gap. So to afford the median priced home that I referenced earlier, the minimum household income needed would be about $107,000. That's obviously out of the grasp of many, many would-be buyers. Now, the result is homeownership became unattainable for a large swath of these same buyers. And how has the market responded? Simply with a drastic slowdown in transaction volume. Mortgage applications, in fact, were down as much as 85% year over year. Why? Well, let's conduct a thought experiment. Put yourself in the shoes of a home seller right now. You're a home seller with an existing mortgage of between 2 and 4%, and your house has doubled since 2008. You're sitting on a ton of equity, but you've also been watching the headlines in newspapers and popular news outlets about the housing market softening. What would you do? Would you sell? Most people wouldn't. And in fact, that's the situation we find ourselves in, where there are just not that many existing homes on the market. You know that if you sell, you would have to find another place to live. So that would mean that you would have to pay a still record high price for it. And if you're getting financing, you would probably be paying somewhere in the sixes in terms of your rate. In this map from the Harvard study, you'll see here colored areas throughout the United States. And really, the orange areas are the most unaffordable, you could say. Yellow is next, and then various gradations of blue and gray. And basically, the more orange the color there is the higher income needed to afford the median home price in that area. So you can see for a lot of these areas, if you're a middle income earner, it's just not attainable for you to buy a home. Now, that's on the demand side. Let's talk about supply, housing construction. So we have, on the bright side, had a really good run of housing construction. In fact, the supply of new units has in some ways risen to meet the demand. In 2021, in fact, single-family starts rose to 1.1 million. This is the first time that they've broken the 1 million mark since the great financial crisis in 2008. Multifamily starts also reached a high, a 30-year high, in fact, at 470,000 units. However, starts don't always translate to completions. And this is particularly the case today, where a lot of these construction of these houses and multifamily units are taking a lot longer than it did pre-pandemic. And that's due to the labor shortage, as well as issues with materials related to down supply chains. Now, this supply, if we look at it historically, it's actually the highest it's been since the 70s. And that's a good thing because, like I said earlier, we are really underbuilt in this country. Now, the problem with what's being built today is that it's almost entirely Class A housing. So that's not necessarily going to cater to, workforce housing and really middle income housing. It's really luxury resort style apartment buildings and houses that are being built, not starter homes and B and C class housing. The typical asking rent for multifamily units, just to put it in perspective, today stands at around $1,740. For a lot of people, that's not affordable. In fact, what is affordable to the median renter? It's about $1,080. So you've got about, a $600 to $700 delta there between what's being built and what the median renter can afford. Now, looking forward, the Harvard study talks a lot about how do we fix the affordability gap. Now, one of the things that we have to do in order to understand the affordability gap is look at what's called cost burden. And in the case of housing, the government defines cost burden as a resident spending more than 30% of their income on housing. Now, a full 46% of all renters are cost burdened today. While to make these numbers even more stark, a full 24% are severely cost burdened. And that's renters who spend more than 50% of their income on their rent. Obviously, this problem affects the people at the bottom the most. Keep in mind that over the last couple of years, not only has housing run up, but also inflation in general. During that same period, inflation has compounded a lot of the issues that the average renter faces when re-signing or getting new leases. Food prices were up double digits in the last year, and housing spending on food, household energy, and gasoline is up about $200 per month in the last year. So that puts a lot of strain on consumer balance sheets. Now, turning to this graph here, you can see that a lot of the cost burdens, unfortunately and understandably, fall on the people on the lowest end of the socioeconomic ladder here. But it's not all doom and gloom. In fact, some states are starting to respond to this by loosening up land and zoning regulations, introducing things like upzoning and densification, starting to accept ADUs, that's additional dwelling units, as well as putting in place local affordability requirements on new development. So all of this is really designed to incentivize supply and help developers make financial sense of building new properties. Today, however, developers are hampered by two things chiefly, one of them being labor shortages and the other being restrictive local land use regulations. So while states are doing some things in that vein, there aren't enough states that are making strides forward to be able to really catalyze the amount of supply that we need in the housing market. Now, to close it out, this paper talked about the outlook going forward. Now, obviously, the Fed has a huge impact on markets, and in the way that they set their interest rates and constrain the flow of capital, that's their way of taming inflation, but it also has a huge influence on the housing market. So the question is, can the Fed do their job? That is, can they achieve the taming of inflation without plunging us into a serious recession? While Harvard seems near-term bullish for that and for housing, there are some economists out there that believe that a hard landing is all but inevitable. However, on the positive side, demographics, low unemployment, and wage growth all bode well for the economy. Supply chain delays are also waning as China reverses its zero COVID policy. However, supply takes time. Not only that, supply isn't meeting demand of the median income buyer right now. This is pushing housing affordability to a limit of what most economists consider sustainable. On a positive note, the construction innovations of the last decade, such as modular and prefab home building, do hold promise if their adoption is widespread amongst both consumers and municipalities. Land use regulation reforms are also vital in the fight to promote affordability and housing. NIMBYism and the feeling of not in my backyard must be overcome. All of that said, as hopeful as I am that we as a nation can solve the affordability issue, the current supply-demand gap is large. Some metrics put it around 5 million housing units, and that's unlikely to reverse anytime soon, despite the best efforts of both the public and private sectors. In closing, the COVID pandemic proved how fundamental stable housing is for public well-being. Politicians and private industry must shift their attention to policies that work. Policies and innovation that support the growth of first-time home buying, that expand affordable housing, and that induce capital investment to an aging housing stock. Also, a slowing domestic population means that we'll need more immigrants in jobs like trades and construction than ever before. So in closing, I just want to say that everything presented today was a restatement and, in my own words, of the Harvard research paper that they put out on the housing market. And none of it was intended to be presented as a political statement. Solving the affordability crisis is an American issue. It's not a right or left issue. And it's going to take work from both the public and private sector. The COVID pandemic, if we learned anything from it, it was how fundamental stable housing is to the public well-being. And politicians and private industry are going to have to shift their attention to policies that work in this vein. We're going to have to rely upon private and public sector to create policies and innovation that support the growth of things like first-time home buying, expanding affordable housing, and inducing capital investment into the nation's housing stock. This is something that we can do together, but we will need help. A slowing domestic population means that we'll need immigrants in jobs like trades and construction more now than ever. So these are some of the issues that we're facing in the housing market today, as well as some proposed solutions. But I'm curious to hear if you have any ideas on how to solve the affordability gap. With that, I'll sign off, as we always do at Maple Capital Partners. Be kind, be charitable, and invest wisely, friends. Thanks.